Good afternoon, everybody. I am Jenny Jeffress, and I'm the Executive Director of the Madison Public Library Foundation. Thank you so much for joining us for our workshop today. The workshop today is titled Making the Most of Year-End Charitable Giving. And we have a very esteemed group of panelists who are going to talk about this, all kind of the ups and downs and advantages of how to make a gift and what's the best way to do it. So I'm very excited to welcome this group to talk about this topic today. You're going to have lots of opportunity to ask questions and get answers. So we want to make sure that everybody feels like they leave with something valuable today after participating in this workshop. The foundation has been doing about 4 workshops a year, and we really listen to what people want to hear about. And so we appreciate it when people give us their thoughts and ideas because we want to respond to what you are interested in. So we have a number of our donors and a number of our patrons of the library who get to enjoy these programs. And we just want to thank you for participating. We really appreciate your support. So now it's my pleasure to introduce our moderator. Our moderator is Angela Davis, and she is part of the Madison Community Foundation, who is a great friend to the Madison Public Library. So let me tell you a little bit about Angela as she moderates our session today. She is the Development Director at Madison Community Foundation. She assists individuals and nonprofits with achieving their philanthropic goals. She's also the staff liaison to a fund for women and to MCF's 6 regional giving partners in Wisconsin communities of Lodi, Columbus, Middleton, Monona, Portage, and Rio. These partners work with MCF to support specific community causes. So I welcome Angela, and she is going to introduce our panelists. Thanks, Angela.
Thank you very much, Jenny, for inviting me to moderate this panel, which includes 3 dynamic panelists that will share some very important information on making the most of year-end charitable giving. Now, I would like to invite Jessica, Sheila, and Laura to introduce themselves.
I will start. My name is Laura Murray. I'm a financial advisor with Baird here in Madison on the Square. I've been in the industry about 20 years, and before that, I worked in a firm doing estate planning and divorces. So very happy to be a part of this call today and a volunteer for the Library Foundation. So glad to see all these wonderful attendees and look forward to our discussion.
Good afternoon. My name is Sheila Stevens. I'm an attorney with the law firm Michael Best Friedrich and a past board member for the Library Foundation. My practice really focuses on estate planning, trust and estate administration, and charitable giving.
Good afternoon, everyone. I'm Jessica Schwantes. I am a tax partner here at Wipfli, as well as the market lead, and a former past board president for the Madison Public Library Foundation. So I've been with Wipfli for over 20 years now, working with businesses, individuals on their tax planning and tax compliance needs, and happy to answer any questions everyone has as they get ready for their year-end giving.
Thank you very much. Before we begin, again, just to reiterate what Jenny has stated, if you have any questions during the discussion, please use the Q&A box. We will be looking out during the presentation for your questions. So let's start with you, Jessica. This is a question we have seen numerous times and has been shared with us. Is there a tax advantage for a person to use their individual retirement account to make a gift to a charity? And are there certain types of charities that receive these donations from IRAs? Again, that is an individual retirement account. We're going to try very hard not to use all the acronyms that we use all the time to make sure that we are communicating very well. So tell us more about this, Jessica.
Yeah, absolutely. And yeah, I'll be hard on the acronyms because they're there a lot from that part of it, especially in our industry. So just just nod me from that part of it when I need to go ahead, but absolutely. So a lot of individuals will have individual retirement accounts, most people know them as IRAs. And there's magic ages, as we like to call it, from that you have to take distributions out of them. And so a lot of times you'll hear them called RMDs, so required minimum distributions. And several years ago, the IRS and Congress passed laws that will allow individuals to, instead of taking their required minimum distribution, so once it's over 70.5, because that was the rule at that time, that instead of taking that distribution, you can have it go directly to a charity. You don't get it counted as income on your tax return. You don't get the charitable contribution, but it definitely helps on that part of having a tax advantageous way to do. It became a lot more popular to be done when the Tax Cut and Jobs Act went through in 2017, and they raised the standard deduction up to $12,000. It's been indexed for inflation over the last several years. And so a lot of individuals don't itemize for their tax return anymore. And so this way, then they can still get a tax deduction by not including income on their tax return. So it's very advantageous to do that for tax planning purposes. There's some limitations on it. So to do it, the dollar amount has to be less than $100,000 per person. So if you file a joint tax return, you do get $100,000 for both you and the joint filer from that. And it has to go to a qualified charity. So everyone's like, oh, qualified charity, another qualified world. What's that rule for? And so that's most charities, so 501c3, so like the Madison Public Library Foundation. The one type of charity that we do get questions on a lot is several individuals have set up donor advised funds or DAFs, you'll hear them. And those aren't allowed to receive your qualified distribution from the charity or from the IRA from that. So you'll still have to include those as income on your tax return, and then still can give the cash and get a charitable contribution if you're itemizing that way. But they're great ways to do it. I'll tell theirs from that I believe so much in it that I have set my parents up to do them on that part of it. So I think one of those is like, well, should I do it? I'm like, well, I tell my parents to do it. So I guess that's how well I believe that they're a great opportunity.
Right. And Jessica, as you mentioned, you can't use it for DAFs, but if you wanted to support organizations that did, qualified organizations that had endowments, for example, at Madison Community Foundation, those funds could be designated at the time of the gift, just to throw that in. And also we have a question from Diane, Jessica, can inherited IRAs be used for charitable giving? Jessica, can you answer?
Yeah, so you know what? I'd have to probably double check on that one from that, unless
Okay.
I think Laura is just shaking her head from that. But because it talks about required minimum distributions, you do have that for inherited IRAs. So I believe those still work, but I'd have to verify that. So Laura, you know?
Yes, you can use inherited
Okay.
IRAs.
Thank you.
Okay,
Sure, no
thank
problem.
you. Thank you. Keep putting those questions in. Sheila, we have heard a lot about proposed law changes for 2021. And we had a good discussion about that when we chatted last week. What are some of the proposed federal tax law changes for income tax or estate purposes that could affect those on the call today?
Well, this has been a very much a moving target, and I think in my world anyway, very frustrating as we wait to see what is actually gonna come out of Congress, if anything, on the tax law changes. In fact, I believe this morning the House just passed a bill this morning on the Build Back Better, and so we'll wait to see what happens in the Senate. There's been a lot of talk about increasing capital gains tax rates. And as far as I know, and Jessica, feel free to hop in if you see something else on the income tax side that I'm missing, but that is not to occur as of right now for 2022, but we wait to see what's going to happen there. Certainly if the capital gains tax rates go up for those people who use appreciated stock, for example, for their charitable giving, that may be even more attractive next year if the rates were to go up. But again, we sit and we wait to see what's going to happen. I believe as part of the House bill that we may see the SALT deduction for state and local taxes going up from 10,000 to 80,000, at least as part of the House bill, and we'll see what'll happen there on the Senate side. And beyond that, I know there's been some indexing that are going to affect tax brackets. And Jessica, is there anything else on the income tax side that you want to jump in on?
Yeah, I mean, it has definitely been difficult because the tax proposals that we had in September that had tax rate increases in their capital gain rate increases. And then when the Build Better Act, which is a tongue twister for me to spit out from that part of it, was proposed by Biden at the end of October, kind of took all the tax rate increases out. So a lot of changes that we thought we were going to have for year-end planning, for rate increases, and then they're all taken out, which just, and some might take the political part to make sure a bill can get through before the end of the year. So there's all the devil's in the details, and negotiations are still going between the two sides. So we'll know more hopefully by the end of the year. But a lot has kind of flip-flopped and changed since we had the first proposal back in September.
Yeah, on the estate tax side, we really had some frenetic planning, people trying to get gifts done before those changes. And as of right now, those changes are not coming through. We are scheduled to see the estate tax free amount go down from this year it's $11.7 million. It gets indexed for inflation every year. It's going to go down to 5 million, again, indexed for inflation. So probably closer to 6 million in 2026. There was discussion that might occur, and they might move that up and occur actually January 1st of next year. As of right now, that's not going to occur. But if we do see the estate tax exemptions go down for people who have a desire for charitable giving, that may make charitable giving at the time of death perhaps even more important as part of their estate plan to help minimize estate taxes.
Thank you very much to both of you. Laura, we are going to talk about something that we hear a lot about, and keep putting those questions in. We will get to your questions. We are going to talk about, in 2017, Congress passed the Tax Cuts and Jobs Act that practically doubled the standard deduction. Standard deviation.
Deduction. You were
Deduction.
right.
It is deduction. That's what I thought. Okay. Standard deduction. As a result, we hear of donors bunching or bundling. We hear both words, bunching and bundling their donations. Laura, what is it? And what are the advantages to bunching or bundling?
Sure. Basically, bunching or bundling is simply accelerating or deferring your charitable gifts. And certainly when we change the way we gift, if you're a consistent donor to the Library Foundation, we want to tell our charities first and foremost so they can plan cash flow wise. But I'm going to share a slide that really illustrates this best because I hear so much about this. I talk to clients about it all the time. So I'm going to go ahead and share that slide.
Okay.
You should be able to see.
Yes.
Great. So if we think about bunching, and the size is okay, everybody? Yes? Okay.
Yes.
So if we think about our giving over a series of years, we look at what we pay for income taxes and whatnot, mortgage interest. We have our charitable contributions. We're giving the library $5,000 a year or whatever is comfortable. We have that huge standard deduction. And this, of course, is the married filing jointly deduction. So our itemized deductions don't outstrip that standard deduction. So we end up with the standard deduction if we stay with our $5,000 per year. Now, if I bunch my $5,000 gifts and maybe I don't do one for 1 year and then I do 10,000 every other year, you'll see we jump our annual deductions up a bit. And over a period of years, I end up getting larger deductions. Now, of course, we love our charities. We don't necessarily want to stop giving to them in certain years. That makes it tough on their cash flow. So what we can do is you may want to give to them every year, and maybe we won't outstrip that standard deduction every year, but we can certainly bunch them in particular years to get a larger deduction. Does that make sense?
It does make sense. So what you're really saying, we need to have that communication with the charities that we support.
We do. I'm going to unshare for a second. One important, somebody had just asked a question about using inherited IRAs, and I failed to mention, you do have to be 70 and a half to make that. So if you're 35 years old with an inherited IRA, that's not going to work for you. Just wanted to add that point of clarification. But certainly bundling is a good way to increase your deductions, and talking to your CPA or your tax preparer about that is a good thought, as well as your charity, of course.
Thank you. And speaking of charities, we have a question from Karen. I give monthly donations to about 25 charitable organizations. Thank you, Karen. Would it be a tax advantage to withdraw from my IRA rather than receiving the MDR and then contribute? But is it possible to draw out of IRAs monthly or on an annual basis to distribute MDR from one IRA to many organizations?
Absolutely. And the important part of using an IRA, required minimum distribution, RMD, whatever vernacular you want to use, in order to give that to a charity, is it has to go right from the IRA holder, say that was Baird, directly to the charity. So when you contact your financial advisor or whomever holds your assets and say, I'd like to give these things to charities, I want $500 a month to go to the library foundation or what have you, you will probably have to fill out a form for each charity that you want to do this to. Certainly, once you get through the initial paperwork, it should go like clockwork. They should be able to do it monthly, because you can take your required distribution any way you want it. In fact, most people take them when they retire a little bit every month because they're replacing their salary. Also, you don't have to take it from each one. So say you had multiple IRAs, you can take it all from one if you have some kind of investment strategy that you don't want to be disrupting in another. So you should have great flexibility on how you want to do that, and can continue to be incredibly generous. I love hearing the stories of people doing that kind of giving.
Absolutely, because it makes a huge impact in our community to have such generous donors that give to the Madison Public Library Foundation and the other awesome and impactful organizations we have here in Madison, Dane County, and throughout the country. Oh, we haven't, okay, the IRAs are hot. Okay. Didn't the pandemic prompt a change for the age at which one must take the required minimum distribution from one's IRA, 70 and a half to 71 and a half?
So yeah, so it wasn't necessarily the pandemic, but it was right before the pandemic. The PATH Act was passed in January of 2020. And that changed the age for the required minimum distributions to go from 70 and a half to actually 72. But what didn't change is for the individuals that want their required minimum distributions to go directly to charities from that part of it, that age is still 70 and a half.
Thank you for that clarification. Keep those questions coming.
Great question.
Very good. So Jessica, you're on a roll here, and don't worry, Sheila and Laura, I'm coming to you. What are some, okay, so we're talking about giving to charities, and we've talked about IRAs, but is there tax advantages? What are some of the tax advantages, ways we can give gifts to charity? Is it better to give cash gifts, stock gifts, or direct gifts from IRAs? And I know we've talked about IRAs, but I don't think we can talk enough about IRAs, but I'm sure some in our audience would like to know about the other ways with cash gifts, stock gifts, and those direct gifts from that IRA, from their IRAs.
Yeah, from that. So I mean, I'll go in general. I mean, kind of what's best for you is going to matter on your individual facts. But if I kind of say in general, what I see for helping clients plan to kind of put it a filter, if they're going to have that charitable contribution that they want to do, and then say, okay, what's the best tax way to do it? If coming from that filter lens, that if you are over that 70.5 and you have that ability to take it out of an IRA requirement, that's usually the first place to have people start with. The second one from that is if they have highly appreciated stock, to go ahead and use those assets to do that, because you get to remove those assets from your estate. You avoid paying the capital gains tax on that piece of it, because you get that fair market value adjustment. And if you look at portfolios, what I've seen, again, not my area, but what I see on that part is that there's a lot of a highly appreciated stock right now in people's individual portfolios. And so to go ahead, if you're looking to say, hey, I want to make this gift, I have this pledge payment to do, looking at those highly appreciated stocks is a great way. And cash is always good, but when you're looking for that tax event and advantageous way to do it, it's definitely coming from the IRA first, and then the stock gifts from that. Now, with your charities, when you're giving kind of the non-cash ones, I mean, you definitely have to work with your investment advisors and the charity, so the timing of all that can be done. If you want it by December 31st, that they get lead times. So that varies by the investment places from that as the charity, just because there's a little bit more steps to do to make those gifts than it just writing the check and making sure it has a check date of December 31st on it.
And this year's a little tricky with December 31st falling on a
Saturday.
On a Saturday and New Year. So make sure you're having those conversations like now with those important parties. Thank you.
Can I jump in on stock gifting too?
Yes.
And Jessica, you answered that beautifully, but I have a slide that shows you the benefits of donating appreciated securities. Also, I just want to mention, Angela, you brought up a really important point, and that's timing. So if we think about when we gift our stock to a charity, I'm going to start sharing. Mm-hmm. The actual receipt of the stock is when they take control of it. So if it happens to leave your account on the 21st and arrive on the 22nd, the actual date of the gift is the 22nd. So you want to allow some time. Now, these are electronic stock transfers. They're going through a national system. So, sometimes it can take our systems, Baird or whoever you work with, a day or so for that to get into the account and the charity to be in a position to sell it. And until they can actually sell that stock and it's in their account, it is not received. So if we look at, and you can see my slide here.
Yes.
Our friend Sally is donating 1,000 shares of stock. It's worth $11 a share. So if we think about her selling her stock and then giving the gift, her tax deduction is going to be lower than if she just gives the appreciated stock to the charity. And that just makes a ton of sense. Also, the charity doesn't pay capital gains. So we don't care how much you made on your Apple, Microsoft, or whatever kind of stock you hold with big gains. They don't have to pay taxes on it. And sometimes I'll talk to clients and they'll say, well, I really love my Apple stock. And this is not a recommendation, just a sample. I really love my Apple stock. I want to continue to own it. Great. Donate the highly appreciated piece to charity and buy more Apple stock. You can do that. Use cash to buy more stock and you've just reset your basis. So I think stock giving is a wonderful way to take care of a tax problem for you and give a charity a gift that gives them a ton of flexibility because they can sell it and work with you on it if it's for a pledge or what have you. And it's really, really easy. So I would encourage stock gifting. Sometimes people ask about tangible gifts. We do have clients that have things like commodities like gold or silver. Those do have higher capital gains rates, right, Jessica? Yeah. So, you know, you think about you're saving your 15% on whatever your capital gain is with stock. I don't know the actual rates on gold and silver, but I know they're higher. So those can be attractive charitable contributions as well, as long as the charity has a way to negotiate that commodity. So always talk to your charity first. And it's always a good idea to talk to the charity first with the stock gifts, because when we see those gifts come into our charitable accounts, and I have many of them, we don't necessarily get a name. Sometimes the system sends it, sometimes it doesn't. So if you don't want to remain anonymous and you want your charity to know you're giving, throw them a quick email or a phone call and say, hey, I'm giving you 1,000 shares of Apple or whatever you'd like to do. That would be a very generous gift.
Yes, it would. Absolutely let the charities know, because we typically don't know, and we're trying to solve a mystery, and that starts to take time. Oh, I see a question. Sheila, we have a question. I have a question for you, and this is okay, I see a question. Does MCF sell commodities? That is a very interesting question. We would need to know what the commodity is, and we would have conversations with our Vice President for Finance and Operations to see if that is possible. So again, that would call for us to have those communications so we know exactly what the commodity is. Hope that answers your question. And Sheila, okay, we're going to talk about the federal gift and the state tax exemptions. Okay, the federal gift, and we're switching gears a little bit, but it's all tied together. The federal gift and tax exemptions are scheduled to decrease significantly in 2026, or perhaps as early as 2021. We don't know yet. Given these changes, are there advantages to including charity as part of an estate plan? And now we're talking about estate planning for everyone out there. And this is a hot topic and very important piece that we wanted to make sure to discuss today. Sheila?
Yeah, so for people with larger estates where they're worried about estate taxes, certainly including charity as part of their estate plan, it may be beneficial because they get, you can do unlimited amounts to charity at the time of death to avoid the estate taxes. There are some differences when you're thinking about what's the best asset to give when you're talking about gifts to occur at the time of death versus gifts that you're making during lifetime. When someone passes away, let's say their appreciated stock, for example, gets a new cost basis under current law to the fair market value as of date of death. So usually we think about those capital gains taxes as being wiped out as a result of death. So appreciated stock isn't necessarily the best gift to look at for charity at death. Really, the best asset usually is to look at traditional IRAs, tax deferred accounts, because not only would you avoid the estate taxes if your estate is large enough to be worried about that, but you avoid all of the income taxes by leaving with any portion of the IRA that you leave to charity. So that can be very, very beneficial. And you can leave the IRA to any charity, including your donor advised fund. So although there are limitations during lifetime in your ability to do that, if you're talking about the direct IRA to charity transfer at death, you can absolutely do that.
And Sheila, these are tough conversations that I know that all three of you have with clients and individuals and families, and trying to assist them with their estate planning, because there are tough conversations to have, and to have those professionals in place to be able to assist is very, very important. Are you seeing more of those conversations? Because I can speak for MCF. Since COVID, we've had a tremendous increase in conversations regarding estate planning.
Yeah, it is as a result of COVID, it is, I think, more on, it's just more on people's minds. We know, or either directly or a couple steps away, people who've actually passed away from COVID, who have been very, very sick. And so I certainly am seeing people who have been in the last couple of years very much thinking about their estate planning, wanting to look at it. If you haven't done so in a while, it's a very good idea to just review that every few years, make sure that there aren't law changes that affect your plan. And certainly there may be family circumstances or other changes that make it a good idea to revisit it periodically.
Thank you. Laura, Jessica, did you have anything to add in regards to estate planning and the time we're in now?
I think Sheila makes a great point. Gifting your IRA to a charity is a wonderful way to, leave a legacy. Because if you think about it, your beneficiaries, and a lot of people, the biggest part of their net worth is their IRA. So if you do want to have an estate plan that gives some money to your kiddos or family or friends or what have you, or some money to charity, you think about it, your kiddos are going to pay their effective tax rate to take money out of that IRA. We're going to pay ordinary income, but the charity doesn't. So they are just going to receive that asset, and it's really powerful.
Totally.
Yeah. Oh, go ahead.
I was just going to echo on that part of it. A lot of the questions I've had, I'd say in the last 6 months on that is, what type of assets do you want to leave your heirs to leave them in the most kind of tax advantageous place? So since we get the step up in basis, let's leave the stock, leave appreciated securities for that to them. If they do have that charitable intent with their, absolutely leave the IRAs, like as Laura said, because you don't want to pass that tax burden cost onto your kids, especially when they change the law. That the IRAs have to be paid out to your beneficiaries in 10 years rather than over life expectancy. It's definitely kind of increasing the tax burden onto your heirs from that inherit the IRA. And so they're looking at different options to make sure you're maximizing the amount of assets that get to your heirs.
And again, this is a topic to be communicated amongst, if you've got a CPA and an estate planning attorney and a financial advisor, make sure that we all know what the other is doing. When you're going to see Sheila to update your estate plan, make sure you let us know, Jessica and Laura. And we're happy to, especially talking to heirs when we get to end of life conversations, meeting them ahead of time, that can be very beneficial too. If you're willing to share your plan with your heirs, introduce them to your Sheilas and your Jessicas and your Lauras, because that can make that transition smoother and more efficient.
Very good advice. Thank you. If we have any other questions, please put them in the question and answer box. That's what we have our experts here for. And I see one. At what year did the 10-year rule affect IRAs?
I'm pretty sure that was with the PATH Act that went through in January of 2020.
Thank you.
And I will just add, oftentimes as part of your estate plans, if you have, let's say, trusts for children or grandchildren, your documents may have language dealing with IRAs that become payable in trust. And because of this change with the adding this 10-year rule, you may well want to make changes to those provisions. For example, you may have, in the past, we would use life expectancy. So a little bit of money would come out for when children are they're young, a little bit every year. With a 10-year payout, now if you have a trust, you're potentially forcing all of that out more quickly than what you might want to. So it's worth revisiting your estate plan to look at that and see if you might need to make some adjustments to the language in your documents about IRAs that could become payable in trust for children or grandchildren.
Thank you. We have another estate plan question. In estate plans, are Roth IRAs also best given to charity rather than heirs?
Well, your Roth IRAs are not subject to income taxation. So the traditional IRA is the better place to look for your charitable giving at the time of death. Your heirs will have to start to take Roth IRA money out, but obviously it's not taxable to them. So it's better to leave Roth IRAs if you can to family, assuming you have a charity family split that you want to make it at the time of your passing.
Okay, I know it has to be someone on here that's thinking what I'm thinking. What's the difference between Roth? And I know we go through this all the time. So somebody's gonna have to do it. What's the difference in Roth IRAs to the other? So just break it down for us, please. Someone, please.
Jessica, do you want it or should I take it?
I can take it from that
Great.
private. So
Okay.
there's two types of individual retirement plans, IRAs. You have traditional ones where individuals most of the time will get a tax deduction when they make that contribution. The assets then grow tax-free in these retirement vehicles. And then when you pull them out, that is then when you're going to go ahead and pay ordinary income tax on them. If you go ahead and elect to do a Roth IRA, the Roth IRA individual retirement account, you do not get a tax deduction when you make that contribution. They still grow tax-free, but then when you pull the distributions out, you don't pay taxes at that point in time. So they're
Before 5 years though, don't you pay taxes on earnings? They have to exist for 5 years?
well, yeah, they would.
Okay.
I had never seen that in 20 years. From
I've
that
never seen it either.
from that part of it. But yeah, there is that odd part where, yeah, if you created it and then were to pass in 5 years or pull money out in 5 years, yeah, then you could. But I just never seen that happen.
Me neither. I've had people ask and then I tell them that and they're like, oh, I don't want to do that. I will add, some of you may be doing backdoor Roth contributions. If your income is too high and you don't qualify to contribute to Roth, you may be contributing to an IRA and then converting it to a Roth. You're probably not going to be able to do that if your income is over a certain level. With the upcoming tax proposed changes, we'll see, but I think that's one of the things that's on the hit list, isn't it, Jessica and Sheila? Those backdoor Roths?
I don't think they're on anymore.
Oh, they're not. Okay, good to know.
Very interesting. We have another question. Well, this is a good one. All of them are good, but this is something we haven't discussed yet. If you have money still in a 529 plan at death, can you gift that to heirs or to a charitable organization?
Oh, I've never had that question. I don't know that you can give that to charity. You can shift it over to, if you're the owner on the 529, you can certainly switch it around among your individual beneficiaries, but I don't know if you can do that to charity.
I'd have to check that one.
I would think you would just, I mean, I don't know, but I would think you would have to just take out the money and give it to the charity. You can't name the charity as a Benny. That's a really good question. But hopefully as part of your estate planning, if you were having significant amounts of 529 money that hadn't transferred, you'd start looking around your immediate family or you know, people within your generation in your family to transfer that benefit.
My initial thought, without having looked into it, is that 529 plans, the only allowed distribution from there is for educational expenses from that part of it, and any other distribution out isn't allowed. Otherwise, it's taxable and related to that part of it. So I haven't experienced anyone having money left in at death in one of those plans. They are relatively new vehicles. I mean, relatively new. I definitely, we can follow up on that one though. It's a great question.
Very good question.
No idea.
Very good. And we will follow up and we can send that. We'll ask Jenny to send that out when the survey is sent regarding this session. We have another question. I understand 403B accounts, RMDs, cannot be donated to charity and then deducted from taxes. Is it a good idea to convert the 403B to an IRA? So again, I understand 403B accounts, RMDs cannot be donated to charity and then deducted from taxes. Is it a good idea to convert the 403B to an IRA?
Laura, have you seen clients do that? Like with 401ks would be the same, it'd be the same issue for a 401k.
No, I've never seen anyone do that. Certainly you could name the charity as a beneficiary in the case of death, but I don't know. I think I would have to follow up on that.
Mm-hmm. So this will be another question that we will follow up with everyone on that when we send when the Madison Public Library Foundation sends the survey. Do you have a question for Laura? One of the ways savvy donors are given to charities and reducing taxable income is using their annual required distribution from their IRA.
Mm-hmm.
Laura, are you seeing this in your work? And how does that work? Why is it beneficial? And is there a maximum as to what you can give? And I think we touched on that, but I don't think we can touch on it enough.
Sure. So simply what you do is you contact your, investment firm and say, it is my intention to give my RMD to a charity or multiple charities, 25 every month for one of you. And you fill out a form, you give them the contact information from the charity, they directly send a check from that investment firm to that charity. And it has to be that way. Otherwise it's not qualified. So you want to contact them. We mentioned this issue of timing before. You want to make sure that happens. You don't want to be doing this on December 27th, certainly. If you want your gift in this year. And I see people doing it all the time. If we don't have a legacy wish for that, or we don't need that money, there's a lot of people out there who don't need their RMDs, and it just increases their ordinary income taxes. And actually RMDs can impact a number of things. Hang on, I have some great, I have more slides.
Yay. We're visual learners too. So
yeah, it can. So if we use our RMD to give to charity, if we reduce our ordinary income, that has an impact on a lot of things, right, Jessica? Like if you're taking Social Security, the taxability of that Social Security. I mean, talk to your CPA because everybody's situation is different. Mm-hmm. But using RMD for charitable gifts is really powerful. Let me think. Let me. I'll circle back on that topic too. But okay. Yeah, I see that all the time. People, satisfying their pledges to their charities with their required minimum distributions, and the charities don't care. They just want to know that you're giving it and when they're getting it. Exactly. So they can plan for their cash flow.
Especially what our topic is at the end of the year, because that makes a huge impact on the bottom line for the charities that we care about. And Sheila, okay, I see a couple questions. Oh, I see a couple questions coming in. Excellent. Okay. How do I implement the $100,000 max QCD to a charity before death?
Well, so
Laura, go ahead. Laura looks like she wants to answer.
I mean, so the max, so say your required minimum, and this is, I failed to answer that part of your question, Angela. So, but I think Jessica mentioned it earlier. The maximum amount that you can sort of get out of your taxable income using your qualified charitable deduction is $100,000. So say your required distribution is $250,000. That would be a really nice IRA account. And I hope that's the case for everybody out there. But if you have a required distribution of $250,000 for your retirement accounts, you can only send $100,000 out. So you'll want to be maxing that out every year and talking to your advisor and saying, okay, 100 of this 250 is going to the Madison Public Library Foundation or what have you. Not that I'm biased. That's as much as you can do from a tax standpoint. And I don't think that's that's not on anybody's radar to change, right, Jessica and Sheila, the
Right.
maximum
I think that
RMD?
the clarification on that 100,000 is that's $100,000 per year. So if you have
Yes.
more in your IRA, you can leave the entire IRA to charity, but when they're looking at each year contribution, to not have that distribution out of your IRA count as income to increase your adjusted gross income, that's maxed at $100,000 a year. So hopefully that helps clarify that it's a per year versus kind of a lifetime aspect of the plan.
Absolutely. And Sheila, I know we touched on estate planning some. I want to ask another question, and then we have one more question in the chat box. Again, if you have any final questions, please get those in the chat box before we run out of time. But Sheila, many people decide to include a charity upon their death as part of their estate plan. And we know that, is there tax benefits to leaving money to a charity at the time of death versus during your lifetime? And are there benefits to informing charities of your intentions to include them as part of their estate plan as you have, or as you're working with your clients?
Well, we've talked about the tax advantages to leaving property to charity at the time of death. What we haven't really touched on, for people who maybe don't feel that they can give as much as they would like to during lifetime, making transfers at death are a very nice way to support your charity. And what I find is, maybe people are not making large gifts during lifetime, but they would like to do something significant at the time of death. And I think certainly the Library Foundation and other charities, sometimes they get gifts at the time of death, and they may not have gotten much during lifetime, or may not have gotten anything during lifetime. The other thing I would say is it's really, really, really beneficial to, if you're open to talking to the charity, if you're going to, particularly a larger gift, about what you would like them to do with the money, so that they have some indication of what your wishes would be. And charities are very, very happy to have those conversations, very happy to put something down in writing that you can change anytime you want to, because I hear that a lot. Someone's passed away, they left money, and we get the question, well, what did they want to use the money for? And we don't always know the answer to that.
Absolutely. And from a Madison Community Foundation perspective, when you're working with organizations like the Madison Public Library Foundation, they have policies in place on how they treat those gifts when they come in. So they know not all charities do. So you do want to have those conversations, because sometimes it could be a case of be careful what you ask for. If every charity wants that $1 million gift, but how is that designated and how is that distributed in use? Is it for now or is it for later? So having those conversations are key.
Yeah, I can think of, so putting on I sit on the board of another charity. Oh, here's a great comment from Jenny in the chat. Madison Public Library Foundation puts bequests in to our endowment, and a lot of charities do that. But putting on I sit on a board hat, frequently we'll get a letter from an attorney saying, so-and-so left you their house. We have no idea who so-and-so is. We would love to, connect with their family and tell them how grateful that we are. And that's a wonderful thing. But some charities are not equipped to do things like sell houses. And sometimes the things you leave can be not, it's wonderful, we're grateful, but not all charities have the capacity to deal with certain kinds of gifts. I've heard charities that I've worked with before saying, vehicles, boats, things like that, sometimes are more of a pain than they're worth. And so, the most important thing is to be talking to those development folks like Angela and Jenny and having a meaningful discussion. We had a wonderful woman who donated to another charity, and we had probably a 5 or 6 year relationship. She was near end of life, and she wanted to see some of her money in action. And she had very specific ideas of where she wanted money to go. And there were wonderful things that were on our list of things to do when we had the money. And then she left a large estate to us. And those conversations and the ability to express appreciation to her and her family and recognize her and really talk to her about what she wanted that money to do was incredibly valuable to the charity, and especially the volunteers and things like that. I mean, there's a lot of goodwill, good feeling that comes out of that. You can't say enough about that, because working in not-for-profits can be really tough. And having those rewarding, wonderful donor relationships is one of the cool positives and one of the rewarding things that comes out of those discussions. So anyway.
Absolutely. That was very well said. Sheila, you wanted to say something? Then we have 2 questions left in the time we have remaining.
Yeah, let's go on to our questions, Angela.
Okay. Again, related to QCDs, how do I make this, how to make it happen and report it on tax forms? Note my RMD will likely be $5,000.
So I'll take the tax reporting part. I mean, to get it done, you just got to contact your trustee. So whoever holds your IRA, let them know. And as Laura said, there's probably a form to fill out so they know what charity, what their address is, what the tax identification number is. From that, most of them I've seen is you kind of have to have that, get it done before December 15th is kind of the cutoff, just for the logistics of making it happen. I agree from that part of it, but IRS doesn't let me tell them how I think the form should be done. And so you're going to get a 1099-R by the end of January. And it's going to say your $5,000 is the total distribution from your IRA. And then the next box down, it says taxability or it'll say taxable amount, it'll say 5,000, but there's a box that'll say taxability undetermined. So what happens is that you need to tell the person who's preparing your tax return that I gave that $5,000 directly to charity. So on the line, I think it's line 10, I don't memorize the lines on the tax return where it says IRA income, there's going to be a gross amount that's on the left side. You'll put the $5,000 there, and the taxability amount, you're going to have to put 0. So it's not going to match the tax return. And then on the tax return, you put next to it where it says 0, you really will write QCD, or if you're preparing it in a tax software program, it will show QCD, so that notifies the IRS. So I wish that they would go ahead and have this done, that the 1099 wouldn't show it in both boxes, but like I said, Congress didn't ask me, so.
Wish they would have, I really do. So we have another question regarding mutual funds. And this is a question that the Madison Public Library receives often. We get questions from donors about making a gift from a mutual fund. Can you all discuss how it works differently from a stock transfer?
On the tax side, it's no different. It's another security. So whether it's stock or mutual funds, you still get the appreciated value. So whatever the fair market value of that stock, that's your charitable contribution deduction.
Yeah, I mean, really no different on our end. Sometimes mutual funds can take a little longer to transfer depending on where they sit, because you have a little back and forth with the mutual fund company. But really, I mean, we gift mutual funds all the time to families and charities, and it's no different. Just give us some warning. I will say, so if your charity has a relationship with not all mutual funds can be held by all investment firms. So every once in a while, we'll be transferring assets from one firm to another, and we'll get a note from the transfer folks saying, you know, Fidelity can't hold this fund, you have to call the client and sell it. I guess it would be possible, you know, if it's not a widely held fund, that the charity's investment firm might not be able to hold it and negotiate it. But for the most part, you know, that's an easy fix. I would just communicate with your charity ahead of time to make sure their firm can hold it. But I mean, your big fund companies are pretty ubiquitous at every investment firm. It's just depends on where the charity holds their funds.
I would definitely echo that, Laura, as we see fund holders and others that want to give mutual funds. Sometimes if it's not one of the larger firms, we have to open up an account. So that does take time. So again, timing is everything, and communication, so we can get that going as soon as possible. Well, we are almost at the end of our time. Wow. I will give you a moment to give any final thoughts you have. And let's start with Sheila. Any final thoughts that have come up during this hour?
I'm just going to put another plug in for just, you know, looking at your estate plans, making sure this is a good maybe New Year's resolution to have, to just make sure that things are in order. The wonderful gift for your family to have that in order.
Good advice. Jessica?
Yeah, I mean, I think for this part of it here with lots of, at least in the tax uncertainty of kind of where we're going, you know, it's a good time to just kind of pause, see what kind of your intentions are for charity from that part of it. And when you're looking at that, if you want to have a tax focus of kind of getting the deduction, not getting deduction, does it make sense to kind of do the bunching? What types of assets you want to go ahead and look and make sure you're kind of looking on that tax focus so that you can maximize the benefit to you as well as to the charities on that part of it. Because I do know some other individuals that say, well, if I'm going to go ahead and get a charitable deduction, if I want to give them $1,000, but I'm gonna get a deduction for it, so maybe I go ahead and I give them $1,250 from that part of it, so that they're still getting the same dollar amount, and the charity benefits with that additional dollar amount as well. So just making sure you factor in that tax impact of the gift.
Thank you, Jessica. And Laura, any final thoughts?
Communication with your estate planner, with your tax person, with your charity, because we want this to go as smoothly as possible. If you have a complex giving plan, oftentimes we'll be talking to each other. You know, I'll be on the phone with Sheila or her staff, or Jessica or her staff, and making sure that we have the trust name properly at the investment firm, that we have the beneficiaries named properly. You know, and that's part of the review that Sheila's doing. And I will echo, you know, one thing that Sheila said is please review your estate plans regularly. You may not have a big change in your wishes, but the landscape may have changed from a tax standpoint, from a legal standpoint. And so, you know, having worked in estate planning and then in this, that's where things can go really awry, is if you're not reviewing those documents regularly. And that makes both Jessica and my jobs a whole lot easier when you're helping your family, as if your estate plan is in good order. So, and give to our wonderful charities.
Yes, thank you. I'd like to thank our panelists and each of you that have joined us today, and we hope this discussion was helpful. The Madison Public Library Foundation is very interested in your feedback. Please complete the survey that will be sent to you regarding today's discussion, and share your ideas for future programming. This program today was suggested from a previous survey, and we will follow up with some of the questions that were asked, and we'll just do some research and we'll get back with you on a few of the questions. So on behalf of the panelists and the Madison Public Library Foundation, we hope you have a good day and a great weekend. Thank you.
Hey, everyone.
Thank you very much.
Bye.